Right now, while you sleep, your bank is quietly lending your money to a stranger. You still see every dollar in your account, but so does someone else. So how can the same money be in two places at once? That is the question at the heart of modern banking, and the answer will change how you see every ATM you ever walk past. It starts the moment you make a deposit. You hand the bank $100 for safekeeping. The bank records that you own $100, that is a promise, an IOU. But the actual cash does not just sit in a vault with your name on it. The bank is legally allowed to lend most of that cash out to someone else. In most countries, banks must keep only a small fraction of deposits on hand, maybe 10%, sometimes less. This is called fractional reserve banking. Think of it like a coat check at a busy restaurant. The coat check worker knows that almost nobody claims their coat mid-meal, so they could, theoretically, lend your coat to someone cold outside and get it back before you finish dessert. The bank does exactly this, but with money, every single day, at massive scale. So your $100 becomes $90 lent to a borrower, say, someone taking out a car loan. That borrower deposits the $90 into their own bank account. Their bank now lends out $81 of that. And so on, rippling through the system. One original deposit can multiply into several times its original value circulating through the economy. But here is where the bank actually profits. When the bank lends your money, it charges interest, maybe 7% a year on a car loan. When the bank holds your deposit, it pays you interest, maybe 1% a year on your savings. The gap between those two numbers is called the net interest margin, and it is the engine of banking profit. Imagine a water wheel on a river. Water flows in one side at high pressure, that is borrowers paying interest, and trickles out the other side at low pressure, that is savers receiving interest. The wheel spins on the difference, and that spinning is pure profit. Banks also earn money through fees, overdraft charges, wire transfer costs, monthly account fees, a steady drip of revenue that adds up to billions. Investment arms of big banks trade bonds, currencies, and financial products, adding another income stream entirely. But the core engine remains the same as it was centuries ago: borrow cheap, lend expensive, pocket the spread. Now, this only works if depositors do not all demand their money back at the same time. When they do, it is called a bank run, and it can collapse a bank in days. That is why most governments guarantee your deposits up to a certain limit, in the US, that is $250,000, so panic never gets to start. Banks are not vaults, they are pipelines, constantly moving money from people who have it to people who need it, and charging a toll in both directions. Every time you deposit a paycheck, you are quietly becoming a microlender to your neighbors, and the bank is the middleman collecting a fee for making the introduction.